Hello and welcome to this debrief of question 2 from the December 2014 exam. Now this is a 15-mark question on the preparation of single company accounts. Now because it is only 15 marks, you don't actually have to prepare a full set of accounts. What you're being asked to do, first of all in part A, is something slightly unusual in that we need to prepare a schedule of adjustments to the retained earnings of Candy as at 30th of September 2014 as a result of the information given. Now, generally speaking, anything that affects our retained earnings also affects our profit figure. So what we're looking for in each of these points is something that affects our profit that will in turn affect our retained earnings balance. The second thing that we need to do in part B is to prepare the statement of financial position as at the 30th of September 2014. So do read the question carefully. Don't prepare a full set of financial statements because you won't have the time to do it. For 15 marks, you should only be spending 27 minutes on this question, which isn't actually all that long given the amount of work that you have to do. Now, the way that I would tackle this question is probably actually do both parts A and parts B together and work through the information and put it in the relevant parts of your answer. So what I do, once you've had a very quick skim through the question to see what's going on, is to prepare some pro formas, and I've already done this for you. First of all, for part A, we've got our schedule of adjustments to retained earnings, and what I've done is I've just initially put on the retained earnings figure per the trial balance. This is the closing retained earnings for the year, subject to the adjustments that we're given in the question. So that's our starting point for part A. What we're then going to do for part B is I've set up a pro forma statement of financial position. You can see I've put in all the words and no numbers. Don't spend too long on this in your exam, and if necessary, make yours even less detailed than mine. Just put in the main headings of the sorts of things that you're expecting to see, and then you can always flesh it out as you work through the question. Okay, leave plenty of room. It will make it much easier for the marker to follow exactly what you're doing. And then, as well as having these pro formas, you will also need another page which we are going to entitle Workings, and this is where we're going to put all of our relevant calculations. Okay, so what I do first of all then is have a quick look at this trial balance, and you can see we've got various items that are referenced to the various notes just down below in the question. So what I do is try and pick up a few easy half marks first of all and take all the figures that are not going to change, which actually isn't really all that many, and put them into your statement of financial position. So let's get those easy bits out of the way first. Okay, so if we put in within our equity, we have got our equity shares of 40 million, so we can put in this share capital figure and probably pick up half a mark. We've also got our current assets. We're not told what they are, but it doesn't really matter, we don't really care. So 68,700, that's not going to change. And then the same applies for our current liabilities. They're not going to change either. So that 38,400 we can pop straight into our statement of financial position. I've done 2 columns for mine. Doesn't matter if you want to do yours all in one column, it's just for subtotals. Okay, so we can just tick those figures off. Alright, so let's move down and take a look at the information we're given. First of all, let's deal with note 1, which is to do with a loan note in the trial balance. Now, we're told that the loan note was issued on the 1st of October 2013 and incurred issue costs of $1 million, which were charged to profit or loss. Now, hopefully as you read this, you'll remember that they've done something wrong here. Now, when we have debt and we have issue costs, we basically add them to assets if we're the lender, and we deduct them from liabilities if we're the borrower. So that's the first mistake that we need to adjust for. We need to deduct from the financial liability. We're also told that interest of 1.8 million was paid on the 30th of September 2014, so this must be at a coupon rate of 6%. We're told that the loan is redeemable at a substantial premium which gives an effective interest rate of 9% per annum. No other repayments are due until the 30th of September 2018, which means that this loan note is a non-current liability. Okay, so what I'm going to do then is think about the figures that I should be showing in our financial statements. I'm going to start off with working one, our loan note, which we want to be showing at our amortized cost using the effective interest rate in our financial statements. Okay, so let's start off then with our proceeds. So the face value of the loan note when we took it out, if we have a look at our trial balance, is $30 million, or 30,000 if we're working in thousands. So let's pop that into our working. However, the thing that we did wrong is with our issue costs, we should deduct those from our liability. So we don't show them as an expense, but we deduct them from our liability. Okay, the next thing we need to work out are our finance costs on the loan note. Now, although we're paying interest at a coupon rate of 6%, the true cost of borrowing is actually at this effective rate of 9%, because that incorporates the premium that we're going to pay on redemption. Okay, so therefore our finance costs that are going to go into our working will be our 29,000, which is our liability at the start of the year. Multiply that by 9%, and that gives you 2,610. So in a moment, that's the figure that's going to go into our retained earnings, or would go into our statement of profit or loss. What we then need to think about is the interest that we've actually paid during the period. And if we look at our question, you can see in our trial balance we've paid 1,800, so we'll credit cash and we'll debit our liability, 1,800. And therefore, if we add all of those figures together, we will end up with our liability that we want to be showing in our statement of financial position. This is our amortized cost at the 30th of September 2014. So you'll remember when we looked at this in the course notes, we calculated going across in a table. No need really for the purpose of this question. We've only got 1 year, so I've just put my working going downwards. So the finance costs, just to recap, are based on the effective interest rate, and then our amortized cost is if we bear that in mind together with the cash that we've paid during the period. Okay, so let's deal with these numbers then in the main body of our answer. Okay, so for the purpose of our statement of financial position, because I'm on there at the moment, my loan note is 29,810, so that comes from my working one, so that's my liability at amortized cost at the year end. And then in my adjustments to retained earnings, you'll remember those issue costs I charge to my profit or loss account, statement of profit or loss. I need to add them back, because instead of debiting an expense account, I should be debiting or reducing my liability. So add back that 1,000 there, and then take away my finance costs. So this is my true interest expense. So this was calculated in working one as being my 2,610. So I'll just show you where that came from. So that's that figure there. So that's our finance costs for the year based on the effective rate. Okay, don't need to worry about the interest paid. That wasn't included in retained earnings in the first place. So we've actually done everything that we need to do now for our loan note in the question. Okay, so let's move on and have a look at our non-current assets then. So you can see that we've basically got 3 different types of assets. We've got some land, some buildings, and some plant and equipment. And then you can see we've also got some accumulated depreciation on our buildings and our plant and equipment. Then in note 2 we're given some information about things that have happened during the year. So we have done a valuation, we've revalued our land and buildings, plus we need to do some depreciation. So we need to depreciate our buildings over 15 years. We need to depreciate our plant and equipment using the reducing balance method, and we've also got something really fiddly which people always hate, which is deferred tax on our revaluation gain. Okay, so what I'm going to do with this, I'm going to set up another working. So I'm going to call this working 2. So working 2 PPE. And I'm going to do a column for each type of asset. So we've got our land, we've got our buildings, and we've got plant and equipment. So I'm going to keep the land separate from the buildings. The reason for that being that we're not going to depreciate the land, and it just makes it a little bit easier. So let's put in our figures from the trial balance first of all. So our initial cost per the trial balance, we're told that the cost of land is 5 million. And our land and buildings are 55, so therefore 50 million must relate to the buildings. And then my plant and equipment, if I just look up the cost in my trial balance, that's 58,500. So let's put all of that into my working. And then let's also put in the accumulated depreciation in the trial balance. Well, obviously land doesn't have any. And if we just have a look for our buildings and our plant and equipment, that's these two numbers here. So 20,000 and 34,500. Okay, so let's just add all of these together then to get our net book values at the start of the year. So land's got 5,000, 30,000 for buildings, and 24,000 for plant and equipment. So that's our starting position, if you like, before we make any adjustments. Okay, so we are told that on the 1st of October 2013, so on the first day of the year, so day 1 of the year, we're going to revalue our lands and buildings. So because this happens on the first day of the year, we're going to deal with this revaluation before we start thinking about depreciation. So we're told that the land has been valued at $8 million and the buildings have been valued at $39 million. So if we just go to our working, we're going to put in our revaluation. Well, if our land has been revalued to $8 million, that must mean that we have an increase of $3 million. Let's just leave a gap down here and put the 8 million. And then if our buildings have been valued at $39 million, then that must be an increase of $9 million. Okay, so that together brings us up to the 8 and the 39. Okay, so let's just do a little subtotal here. Alright, so that's our revaluation. You can see here if we were to add these together, so if we did a total column, which we don't need for every line, but you can see that we've got a total gain on revaluation of 12,000 for the time being. Okay, we'll come back to that in just a few moments. Alright, so what else do we need to do then? Well, we need to depreciate our assets as well. So we're told that the remaining life of the buildings was 15 years. So that $39 million we need to depreciate over a period of 15 years. So 39 times by 1 over 15 for my depreciation, that should give us an expense of 2,600. And let's just deal with our plant and equipment depreciation. We're told we're doing this at 12.5% on a reducing balance basis. So if we multiply this by 12.5%, then we'll get depreciation on our plant and equipment of 3,000. And if we just add all of that together, that will give us a total of 5,600. Okay, so there's nothing more to do in this working now. So let's just add together all of these numbers. So for our buildings we have got 36,400. For our plant and equipment we have got 21,000, and if we add all of those together we should have a figure of 65,400. So we've got our figure that we can put into our statement of financial position. So let's just pop this figure in. So 65,400, so that comes from working 2. Okay, we also can adjust our retained earnings in part A because we need to record our depreciation, and depreciation reduces our profit for the year, and therefore it's going to reduce our retained earnings. So from working 2, you'll remember we had total depreciation of 5,600. So let's just pop that into our working here. Okay, so the final thing that we need to worry about, which is the bit that people tend not to like very much, is to do with our revaluation. Now we're told that Candy does not make an annual transfer to reflect the realisation of the revaluation gain. What this basically is the extra depreciation that we're charging because we've revalued the buildings. If they're obviously valued at a high amount, we've got a higher amount to depreciate and therefore a bigger expense. What you can do is transfer the difference from the revaluation reserve to retained earnings. We're told that we're not going to do that. However, we need to reflect a deferred tax liability at a rate of 20%. And the reason why we need to do this is because we're saying, well, although the buildings and the land have gone up in value, if we were to sell them, the taxman would want his share. We wouldn't get to keep all the proceeds. So our deferred tax liability is basically going to be our gain of 12,000 times by a rate of 20%, which is equal to 2,400. We're going to come on to the tax in just a moment, but in terms of our statement of financial position, what we will show in our revaluation surplus is our original gain of 12,000 that we calculated in working 2 and take away that deferred tax. So that effectively gives us what we would get to keep were we to sell the assets that have been revalued. Now people always find that very tricky. You probably wouldn't lose too many marks if you didn't get that bit right, but it does come up reasonably frequently, so worth practicing. Okay, so we're nearly there. We need to look at point 3, which is to do with the tax. So we're told that a provision of 2.4 million is required for our current income tax on the profit for the year. And before we go any further, we can actually put that figure straight into our statement of financial position. So our current tax, our liability on our profit for the year, is 2,400. Okay, that per TB should be combined with that figure there, I've just noticed. Okay, what else are we told then? We're told that the balance on current tax in the trial balance is the under or over provision of tax for the previous year. So we're not told which one it is. So if it's an under provision, it kind of comes on the debit side. If it's an over provision, it will be on the credit side. And then we're told that in addition to the temporary differences related to the information in Note 2, we have further taxable temporary differences of $10 million at the 30th of September 2014. Okay, so let's set up a couple more workings then. We're going to have a working 3, which is going to be for our tax expense. And then we're also going to have a working 4, which is going to be for our deferred tax. Okay. Alright, so let's start off then with our tax expense. So there's normally 3 things that make up our tax expense in our statement of profit or loss. First of all, we're going to have our estimate for the current year, So our estimated tax on this year's profit, and that was actually the first thing we were told about in this part of the question, which is our 2.4 million. So that's going to be the first component of our tax expense. We then need to adjust for last year, and if we just go back to our trial balance, you can see that in our current tax account we have a credit balance, and what that basically means is that we had an over provision last year. So say for example our tax T account last year, our tax liability, we maybe had a liability of 11,100. Turned out that we only needed to pay 10,000 to settle that liability. You can see here that when we balance off our T account, we've got excess credits of 1,100. So that is an over provision from last year. So we don't go back and reduce last year's expense. It just means that we charged a bit too much last year. So therefore this year we will reduce our tax charge. So let's just go back to our working. So last year, over provision, let's reduce this year's expense by the amount that we charged too much last year. And then the third thing that's going to make up our tax expense is our deferred tax, which is going to come from working for. Okay, so let's think about what we need to go into our deferred tax figure then. Well, we're told, first of all, that we need to reflect the deferred tax liability on our revaluation. So that's the first thing that we're going to need. Secondly, we've got other taxable temporary differences of 10 million. So the deferred tax on those is going to be 10,000 times by 20%, which is the tax rate, which is 2,000. Okay, so if we just pop that into our working, so just to make it absolutely clear, we're going to have our provision required, which is going to be our 12,000 times by 20% plus this extra 10,000 times 20%, and if you add all of those together that gives us 4,400. So that's what we want our total deferred tax provision to be at the period end. And we can even actually go straight into our statement of financial position and pop that figure in. So 4,400 is what we want our deferred tax provision to be. What we now need to think about is how much it needs to move by. So if we go back to our trial balance, you will see that at the end of last year we had a provision of 2,500. So we've got our provision brought forward of 2,500, which basically means that we need to increase our provision by 1,900. Okay. Now, normally what we would do is we would put that 1,900 straight into our tax expense working as being the increase, but we have to be very careful in this question because some of that increase is to do with our revaluation. So the increase due to the revaluation was actually 2,400, and when we record deferred tax on a revaluation gain, what we basically do is we debit our revaluation surplus in the statement of financial position and we credit our deferred tax provision. Okay, so the credit to the deferred tax provision we're basically doing up here, and then the debiting to the revaluation surplus we've already done here in the statement of financial position. Okay, so therefore that debit entry we don't want to reflect as being part of our tax expense. So instead what we're going to say, well, let's remove the effect of that increase due to our revaluation and say, well, actually, if we take that out, due to our other timing differences, we've got a decrease in our deferred tax provision of 500. So the other timing differences or temporary differences have resulted in a decrease in deferred tax. So that 1900 is the net of an increase of 2400 and a decrease of 500. So deferred tax to go in the statement of profit or loss is actually a decrease of 500. So do be very, very careful with that. People often find it very difficult, and as I said, you can still get a good mark in a question if you don't get it right, but it has come up more than once before, so it is worth practicing and trying to get right for that very reason. Okay, so that's our last figure then to go into our answers. So if we go to our retained earnings working, we can put in our tax expense. Let's just put this in the right colour. So less our tax expense, which is 800, and if we add up all of this column of numbers, we should get 9490. And then over the page we can put this 9490 into our statement of financial position, and we can add up all of the numbers. So no marks really for doing the subtotals, I'm just doing it now for completeness. So we've got total equity of 59090. If we add together our non-current liabilities, we get 34210, and if we add together our current liabilities, we get 4800, and if we add together our total equity and liabilities, we get 134,100. Okay, so that's basically everything in that question then, so we've completed it all. It's a good mixture of some more straightforward stuff plus a few trickier things, but to be honest, all the trickier things in this question are things that have come up more than once before, so it's a good question to practice there for 15 marks. Quite a lot to do, but hopefully have a go at doing that question again by yourselves, and fingers crossed you'll get most or all of it right.